repeat is important, frequency of next purchase is important, and the third parameter is what you earn, what's your gross margin or contribution margin in that transaction. That is going to be important. Put all of this together and then you will arrive at the right mix, and that will directionally guide you in terms of how much should you be spending on a customer. And this changes from vertical to vertical, business to business, everything. So it's going to be something which is intrinsic to you. Whenever you're comparing it with others, ensure you ask them these other set of questions also along with it, because that's the cohesive thing. The other metric that most people use is the payback period, where they say that it's more of a cohort, where you say that I have spent X amount of money on acquiring Y amount of customers in a particular month. By what time do I recover the X on the Y by basis of the repeat transactions in the subsequent month? So it's a cohort that you're building on Y, which is the customer base that you've acquired. So in the next 1 year, if this customer base is transacting so many times that you are able to recover X amount of money on them, then you get a payback period for your customer. So these are the two matrices that would be very important for internet businesses like ours to kind of measure. So when you calculate the cost of customer acquisition, it is going to be very important for you to be cognizant of what cost need to be taken in and what cost need to be not taken in. For example, if you're going to use, let's say, the cost of a PR agency, well, you can't really put a customer acquisition cost to it. It's an ongoing cost, right? By that logic, you have to put every manpower or every operations cost into it, right? Let's say, for example, if you add the cost of a creative agency, you may not want to add that because that's not really directly attributable to an acquisition cost. But any kind of advertising, media cost that you do necessarily needs to be incorporated into a cost of customer acquisition. So for example, whatever you're spending on Facebook, whatever you're spending in media spends in television, for example, anything you do in display or the spends on display, etc., all the media costs need to be definitely included in the cost of customer acquisition. You may choose to not include the cost of creative or supporting functions, which could be a media agency, which could be a creative agency, etc., as in the cost of customer acquisition.
Let me answer the whole ticket size and the LTV and all that repeat buying behavior. I think business like ours, when you're creating category, we are seeing people come back every 6 months to buy a pair of specs. Right, which is of course the industry. Giving you an example of ATV. I mean, our ATV has doubled over the last 2 years. Right, so in fact, our earning per order right now is the highest than any other e-commerce business. You can pick up any e-commerce business across sectors, and I can guarantee you that the money that they make, absolute amount of money that they make across, you can pick up 15,000 average everyday ticket size business or ours, our earning per order will be higher than any other business. So. And to me that happens only when true value is getting created. So people will pay up for it. I think those things can all be figured out.
We heard Richa from Zivame and Piyush from Lenskart talk about key performance indicators like customer acquisition cost, cohort analysis, and the average revenue per user. These are very important metrics that an entrepreneur should track in order to ensure the success of his venture. I'm sure there are more such key performance indicators that are essential for an entrepreneur to track.
Another crucial element to your business are KPIs or key performance indicators. KPI is a measurable value that demonstrates how effectively a company is achieving your business objectives. Organizations use KPI to evaluate their success at reaching targets. Let's look at some of the important financial KPIs. First one being booking versus revenue, for instance, which is applicable in the case of subscription-led models. Let's take an example where you are a gym and you have an annual gym membership for 12,000 rupees on the first day of January. At the financial year close of March 31st, your bookings would be 12,000 since that is more of an internal tracking, basis which you will judge the sales team's performance, whereas your actual revenue would be 3,000. How did you arrive it? It is proportionate to the time period that is passed, which would give you how it would actually reflect in your accounts. While tracking revenue gives you the actual health of the company as on the date, tracking the bookings helps you understand the potential future earnings. Now, let us assume you are an online marketplace, in which case your KPI would be GMV versus revenue. So let us assume on your online marketplace, you have sold an ABC brand's shoe. Its MRP is 2,000, of which your commission from the seller is 10% on the MRP, which is rupees 200. In this case, your GMV is 2,000 and your revenue is 200. Tracking GMV in this case helps the companies understand their share in the market they operate in, while tracking the revenue, of course, helps the understanding and track the performance of the company.
So GMV is gross merchandise value. Gross merchandise value is basically a notional concept when it comes to a marketplace like ShopClues. The term actually typically comes from a more inventory-led model, where people are buying and selling. Companies like, I would say Amazon probably would use GMV, to report the business. GMV for us is a comparative term that allows you to compare a marketplace with a inventory-based model. It is basically sum total of the gross value of the merchandise that is sold on the platform, though the business makes its revenue from a certain percentage of the GMV that we take as a service fee. So revenue for ShopClues, companies like ShopClues or eBay or Taobao would be the take rate that is a percentage of the GMV that is sold. So revenue would be a take rate, GMV is the sum total of gross merchandise value.
And by take rate, it is the commission that the platform charges from the merchants. So revenue is really the money that the platform makes, and GMV is a sum total of the entire value of the products that have been sold on the platform.
Let's look at another KPI, revenue run rate versus the total revenue. What is the revenue run rate? This is the most widely used by the digital businesses, where you measure the revenue of the last month and multiply that by 12 to understand your revenue run rate. So if you had 1 lakh rupee as revenue in the last month, your revenue run rate would be rupees 12 lakhs. Chances, of course, are that at the year end, you might actually be well above or well below, depending on how you perform. Tracking revenue run rate helps companies progressively keep the track of their revenue performance and take corrective measures in time, rather than at the end of the evaluation period. Another crucial KPI is gross profit or gross profit percentage. Gross profit is the profit you've earned after deducting all the direct costs from the revenue you've earned. Keeping track of this gives a good sense of an entrepreneur of the health of the business. If your gross profit as a percentage of the revenue is healthy, then it is a clear indication that you should be spending more time to increase the sales so that the gross profit grows, leading to the profitability of the business in general. But if you find your gross profit percentage is low or negative, then you have a tough task ahead, as you either need to reduce the costs to increase your profitability chances, or you might have to increase your prices to take up the revenues. It's important to study the trends related to the gross profits, as volumes might be impacting the same tremendously, in which case you should then actively work to get on board new and more price competitive vendors to be able to achieve better margins. Tracking gross profit also helps compare between product lines and decide resource allocations for scaling up. A popular KPI to track especially for new age e-commerce ventures, is LTV, or the lifetime value of a customer. So long as your product or service is good, a purchasing customer would be purchasing with you at least a few or more times. For example, if a customer spends 1000 rupees with you on one transaction in which your company earns 300 rupees, the customer is likely to come back for 2 more such purchases. Then the lifetime value of this customer is 900 rupees. Continuing with the previous example, let's talk about another KPI, that is the customer acquisition cost, or CAC. CAC is the amount you spend to earn the 900 rupees we just saw was the lifetime value from the customer. Let us assume that this cost totals to about 400 rupees per customer, in which case you have a profit of 500 rupees from this customer. Needless to add, your LTV should be greater than your CAC, and if it isn't, then either you reduce your CAC or take up your LTV.
If we are going to be looking at new customers that we are acquiring on a month-on-month basis, what is the cost of acquiring those customers? What we did was, we took all our marketing cost and divided it by the new customers that we acquired in a particular month, and that is how we arrived at the cost of customer acquisition. Ironically, this is not entirely the right approach of arriving at a cost of customer acquisition, because you would have, and every company spends money on retention also. You would have marketed to customers who have bought from Zivame on the same channels such as Facebook, on the same channels of SEM, search, display, etc. also, right? I would search Zivame and click on a paid link and come. I would have bought from there, right? So while technically this is not correct, but on a periodic level, if you can look at from a trend analysis and say, hey, this is how my cost of customer acquisition is trending, you know which way you are going.
The other component which you would be tracking would be the monthly burn. So the monthly burn again is very important for the entrepreneur to understand. When you are in your initial stages, you are bootstrapping. Every month you have limited cash flow available and you count on each of them. Most of the entrepreneurs know this number, and it's important to track that when you compare this with what you had budgeted for. This will give you an understanding of when you will be running out of your money. Like for instance, you started with the funding of 1 crore and your assumption of rupees 5 lakhs was the monthly burn, which means that you would be spending your money in 20 months. However, over the performance you had over the last 6 months, you realized that you spent already 60 lakhs, that is 10 lakhs a month. Now you are left with 40 lakhs, and the same rate of your historical 6 months burn rate will lead to only 4 months of funding. This is very different from what you had planned for, and you might have to look for funding much sooner than your plan. This is important for you to understand at every stage of your business, that it's not too late for your business and you don't suffer on your growth path.
Monetization for us was a day one priority. So because we didn't have a lot of money, the understanding between me and my co-founder was, okay, we have probably an 18 to 24 month runway to have a small team and try out working. And also our initial team members took big pay cuts. Most of them were earning like 30 to 40% of what they made before joining Freshdesk. So it was, and me and my co-founder weren't taking any salaries at all. So we thought, okay, our total burn was like 5K USD per month, including everything.
Average revenue per user is another KPI which is very close to what we looked from an LTV, but it's very different. Average revenue per user is effectively your total revenue divided by the total number of customers over a period, whereas the LTV was for your lifetime revenue per user of that particular user. So both are very different. average revenue per user gives you a fair indication of what kind of revenue you are earning from a customer and what is the mix of your customer base. Let's look at the example in a service business. If you have an IT firm and you have a revenue of 1 crore, let's say you have 5 customers. That means your average per user revenue is 20 lakhs. You're having the customers with large ticket. Average revenue per user is also a metric and very different from what we looked at as LTV earlier, from each of the customer on a single transaction. This is average revenue per user, whereas the LTV is the net earnings from one single customer over the lifetime of that customer. So both are different. Average revenue per user gives you a good understanding of how you want to grow your business and how many customers you need to acquire for that. For example, continuing with our restaurant example earlier, if you had a typical restaurant business, you would have dine-in sales and delivery sales. Looking at the average revenue per user on a dining sales versus the average revenue on the delivery sales will give you an understanding of how many customers you need to acquire for each of your vertical. Identifying the average revenue per user for each of your verticals of the business would give you an understanding of how many customers you need to acquire to achieve your targets, and the value should concentrate. Some business metrics with financial relevance are conversion rate and cohort analysis. Now, what are conversion rates? For example, an e-commerce website has various visitors coming on their website, but this number doesn't give you any indication from a financial perspective. However, how many number of people ended up shopping out of the base who came on your website would make sense. This is your conversion rate. The conversion rate is effectively what your funnel is. The conversion is the measure for your efficiency of your funnel, and for example, if you have 1 lakh visitors on your website and of which only 2,000 were the customers, that means you have a 2% conversion rate from the people who came on your website. It might not be that relevant in the initial phase, but over the period, conversion rate is very important aspect through which the growth of your business is measured. From an investor's point of view, business metrics suggest the conversion rate would give them an understanding of the health of your business, how much money you need to invest more on a regular basis to attract growth for the conversion rates. That means you are actually spending much more efficiently on your marketing initiatives, and you can take risks if your conversion rate. That means you are actually spending much more efficiently on your marketing initiatives and you can take risks. On the other hand, if your conversion rates are low and you have a very low margin of error, so that it means you need to be very careful of where you spend. Cohort analysis, on the other hand, measures the repeat behavior of your customers. For example, if you acquire 1,000 customers in a particular month, how many people churn over a period is measured by this cohort analysis. Let's take this one symbol of 1,000 and see in each of the month how many people of this 1,000 are coming and buying again. For example, in the second month there are only 600 people who are coming in and buying, and in the month 3 there are, let's say, only 360 of the first 1,000 people. That means only 60% of your people are coming and repeating in each month. Higher the percentage for repeat for any business is good, because it indicates that you need to spend much lesser than you would grow organically, and in the future much more with what you've already invested. Now, the KPIs which you are looking at as an entrepreneur will be very important with the scale or the stage of your business you are at. And it's important to identify your KPIs from a long-term perspective, such that you don't look at different KPIs as you go along. For instance, when you are at the initial stages of your business, when you are establishing your product in the market, you will want to understand whether your product is a good market fit or it is solving a problem for the customer. For this, you need to focus on the KPIs indicating this. For instance, if your conversion rate is high and more people who visit your website do end up buying your product, will indicate that your product has demand in the market. For you, when you grow and you have already established your product in the market, your focus on the KPIs are from an optimization point of view. That is, whether you can grow your market, if yes, how, and how you can cut your costs. For example, repeat behavior is far more important when you are growing, since you have a large customer base already, and exploiting that would drive profitability as well as growth. You will focus more on your gross profit margins here. Your CACs would be going down, for instance, and so on and so forth. So it's very important for you as an entrepreneur to understand the importance of the KPIs you are looking at and relate that to the stage of your business.